Welcome, everyone. We're here to have a conversation about the role of standardization in the tokenization of stocks and equity. So I have with me Joris, who's the founder and CEO of Fairmint, a company that has been doing tokenization of equity for 7 years now, so he's very deep into the process. Thanks for joining us, Joris. And I'm Nevin. I'm the director of the Digital Securities Initiative, which is a project that's working on regulatory market structure for secondary transactions in tokenized securities, hence us being paired to talk about this. So Joris, why don't you start us off by just talking a little bit about your take on why is standardization so important in the tokenization of equities?
Yeah, so a quick word on Fairmint. We bring equity on-chain by turning cap tables into smart contracts. And standardization, we saw very fast that it was one of the things that were very, very important to make the market works. It basically prevents siloed and fragmented markets, and it gives more efficiency. And so overall, when we start to bring this type of standard, we get a chance to offer better rules, more efficiencies, which is what we need today in most of the market at the blockchain era. So I think, it is really something that we push at Fairmint, and I would be happy to dig on that part.
And so, if the industry were to proceed tokenizing equities with no standardization, what would happen that you can avoid with the standardized approach?
Well, if you lack the standard, you take the risk, like I said, to silo things and to not have access to the same type of liquidity, which is what was the subject of the previous panel. So we need to always come up with a solution that offers more depth in terms of liquidity, more interoperability, and also the entire regulation over the years evolve always in the same way, which was more enforcement, more regulation. But the pragmatism of all the players that were working for years on this, like us, is how can we just offer a common language to everyone so that we can talk the same format, the same messaging, no matter the ecosystem we rely on.
Yep, makes sense. Okay. And so when we talk about tokenizing equities, you have sort of the wrapper approach of taking some existing equity and wrapping it with a token versus issuance of equities directly as a token in the first place. How do you see the difference? Do you think that sort of one standard can work for both, or how do you compare those two?
Well, so wrappers in fine are pointers. It points to something. And to me, it adds lots of complexity because it requires that the buyer of those wrappers will read and have to discover what's exactly pointing to. In the context of a true native on-chain asset, it's very different because everything is governed by a smart contract. The entire ownership, the rights, even the transferability is automated with a smart contract. And so it's obviously more powerful. And I think ultimately, and that was the sense of the update filing of the NASDAQ yesterday, on fungibility, on how they can bring more interoperability under the Reg NMS between the tokenized assets that are mostly wrappers today and what is T+1 settlement today. I think the wrappers were the experiment to showcase that the world wants to buy assets from US companies. And it has to be more borderless, more 24/7. But at the same time, we started to see a lot of pushback from people saying, what are we really buying with these wrappers? And the good solution is probably to just focus on building the right standard to bring the asset natively on-chain.
And so I take it that's what Fairmint is focused on, is issuing the equity natively on-chain. Is that right?
Yeah. So we are extremely focused on the private market on our end, but obviously we observe what's happening with the public market. In the public market, you have the DTCC that is operating as the central agent for everything. And because of that, you don't really need a clear standardization. Everyone is pointing to them. But the moment that you start to go on chain and you create fragmentation, silo, that's harming the market. That's breaking the fungibility. That's diminishing the depths of liquidity as well. And if we come with a solution where, at least in the private market today, we can bring a real standard, then we are fixing that. And we are also preparing those companies, the few companies that will IPO tomorrow, to have this standard while they remain completely private.
Yep. So let's talk a little bit about progress so far. What standards are emerging in this domain of tokenized equity?
Well, I think what was done by the Open Cap Table Coalition 3 years ago. So the Open Cap Table Coalition, for context, it's a group of lawyers and industry leaders in the cap table management tool that decide to team up and say, how can we build a standard for cap tables so that any waterfall that will happen tomorrow will respect the exact same thing, so that any class of shares that will be created in a company, in a private company, will always be the same. And so by doing that, and I think it's a great success, we get a chance today that no matter if you are on Excel, on a cap table vendor, or with whoever law firm you work with, you get a chance to talk exactly the same language and to have the exact same format for your cap table. And it's very powerful when you start to think that you get bigger and that some data providers want to access some metrics, some data, especially if you prepare to file S1.
So it sounds like you're saying that standard can be applied whether an equity is represented as a token or in some other way. Is the point of standardizing across those stages so that a company could start without equity as a token and switch to it being represented as a token, and it would be the same data format in both cases?
Yeah, I think it breaks the idea of what's on chain and what's off chain. You have one unique standard, and from there, you can't literally miss it. Everything is basically identical. You have ISO between what you had previously on your Excel and what is now on DLT. But at the same time, what's fascinating is how it changed the mindset of people. The bringing cap table on chain a few years ago was very tough. Like, even if you are doing equity, you had a lot of lawyers that were considering investment in those equity tokens as non-qualified investment. So we had to come with this standard as a solution to literally prevent them to reject that evolution and that change. And it has been an inflection point for us, because in our business, we went from processing a few $1 million for years to onboarding more than 1.2 billion now. And of course, that's something very significant. We have 150 paid customers today, people that are literally coming to us round after round of fundraising, and onboarding more and more shareholders and stakeholders at large on chain. So the format was a way to offer them peace of mind and to feel that going on chain is just as smooth as 15 years ago going on the cloud.
Yeah. Okay, so Fairmint has, you said, I think 150 companies that have issued their equity natively on chain, over $1 billion in total market value. That's pretty exciting.
And counting.
and so what kind of companies are those? Are those like startups or funds, or what's the sweet spot been so far?
Well, so obviously we bring changes. So when you bring change, you want to work with early adopters. So early adopters today are mostly indeed startups, VC-backed company. And they come at any stage. Of course, at the very beginning, we were with a lot of very early stage businesses, but we have more and more Series A, Series B, C. We even chat now with a potential pre-IPO company in terms of size, in terms of traction. And we see them as, they onboard very easily. They are already convinced. They see some awesome benefits. And we can talk about the DeFi part, but just a very basic one. The simple fact that their shareholders can hold their assets directly in a portfolio. Under the hood, it's a wallet on chain. But that's how it is represented, or it is described by some of the shareholder that we chat with from time to time. And just that is already very basic. But that also opened a whole new world. Because if tomorrow in this portfolio you are able to get a call to action and tap into what I like to call regulated DeFi, then you get a chance to move from 0 to 1 in terms of unlocking liquidity for private equity, and making sure that any stakeholders can tap into any liquidity in the world where it is, where it sits, and all that for a fraction of the cost of what exists before.
And so, how many different companies have sort of signed on to this open cap table format, and what has it been like, sort of trying to build support for it?
Well, I think right now the coalition is over 35 or 40 members. It counts most of the U.S. securities law firm, and last year during the Open Cap Table Summit, Ori, Cooley, Gunderson, they all decided to use that as the standard for all their customers. So it means that today the potential to process what's today off chain into the protocol that we've been building on top of this format is wide.
So like any normal startup that goes to one of those big firms and has them set up their cap table is just automatically done in this standardized format.
Absolutely. And I think what's fantastic with AI today is that we are working to process that automatically, leveraging it with AI and making sure that we can process an onboarding super, super fast. Cool. And I know that in the audience we have my team members and all the tests that we are doing leveraging AI for that are amazing. It can see things that even sometimes lawyers spending a lot of time off chain working on this won't see. Like very basic stuff last week. The numbers of authorized shares was too low compared to what was issued.
Yeah.
And a lot of people went and worked on that cap table, but no one flagged that. Our AI did it like the first second of processing the docs.
That's cool. That's really cool. Thinking about, so obviously this is all within the current regulations and rules. Do you think that the overall current SEC framework for securities can just apply directly for tokenized securities, or do you think we need kind of a rework to reconceptualize, how the rules should work in this new environment?
So that's part of the discussion that we have with Nevin on how can we push to a more self-regulatory framework. Like you said, Nevin, we've been working on Fairmint for 7 years now, and we know that if we try to go from 0 to 1,000 too fast, or if it's too far, a lot of the team and project will die trying to reach that milestone.
Yeah.
And so at Fairmint, after several years pushing for 0 to 1,000, we just went back to the 0 to 1. And I think the SEC today, or more broadly, the securities laws in the US are already usable. You can do already a lot of things if you just play with that rules. And I like to say that our specification at Fairmint are actually the US securities laws. That said, very pragmatically, we learn a lot during all those years. And we try to send that pragmatism to the regulator. And when we were offered to send a written input to the crypto task force, the goal was to try to push the idea of a comprehensive framework that will allow the SEC to not transform everything drastically, that would take years and that would maybe never happen, but more like turning the regulated agent as they exist today into regulated agent ready for the blockchain era. And by regulated agent, I mean transfer agent, I mean broker dealers, like all the players that today can bring DeFi into a more regulated world.
Yeah, that makes sense. Joris and I have been having this conversation back and forth about, do you just incrementally update the regulations a little bit here and there, or do you completely rewrite something from the ground up? And the Digital Securities Initiative exists to basically think about entirely starting from scratch and creating like an entirely new set of regulations that would exist in parallel to Reg NMS, and would apply to what we call the global DeFi market system in addition to the national market system. So we have a whole paper about it. Anyone wants to talk to us about it later. But we do that in part because for founders and companies like yours, you're in the trenches. You have to focus on incremental, changes and immediate adoption. So you kind of need like an industry think tank style effort to think about that big picture. So if there's any geeks in the room who want to think about, 5 years from now, come talk to me afterwards. On that note, we think about this question of, how much of the current national market system will sort of be integrated into the DeFi market system, or will they be separate? So one big question is like, do you think there's a role for the DTCC in a world where all these securities are tokenized, or do you see those as completely separate?
Well, so I see two things. One, there will be no compromise on the investor protection. And so whatever we are building today, the role of the regulator is to always preserve investors and make sure that they come with clear guidance on what can be done and what breach this investor protection. And I could extend that also to the issuer protection, which means that if we operate as a regulated agent, we have to make sure that we shield the issuer himself. Now, if we talk of DTCC, well, DTCC is here to reconcile things. So in the DLT, in the blockchain industry, basically the reconciliation layer is already done by the tech. So what we can see is probably an evolvement of the DTCC itself to a more like reporting and supervision role, maybe going on most ecosystem, taking a node there, trying to be the one supervising what's happening, because of course there will be lots of tension between the change that players like you, like us, are bringing to the market and all these incumbents that want to preserve their role and their activity and their revenue. And in the middle, you will have the regulator that will just do regulatory arbitrage. And so that takes time. It's lots of discussion. But in fine, the role of having observers, people that are a bit like the eyes and ears of the regulator, that are able to see and monitor things, that's probably what we'll start to see more and more. And that's part also of the work that we've been doing at Fairmint with observer nodes, because today we use the Canton network for most of the private companies that use our protocol on request of the board members that were like, hey, if we go on chain, we don't want to be on Solana, we don't want to be on Base, because we have risk that people retro-engineer our valuation or see what's happening on our cap table, and we don't want. But at the same time, going on a more private style ecosystem, you want to still offer to all the data providers, analytic platform, and the regulator the opportunity to monitor what's happening. And so I see an evolution of this role to more compliance and reporting. And that would be a significant market, actually.
Yeah, I totally agree. This is something that we've realized as we've thought deeply about the future, is that there's going to be a huge demand for privacy relative to what we've sort of gotten used to in early DeFi, with companies and funds and all these different, just large businesses coming on chain. But at the same time, you need to have some level of monitoring. So combining those two is a very important part of the future. We're getting close to our time, but I have one more key question for you. So with Fairmint so far, you've got, these 150 plus companies, over $1 billion worth of private shares on chain. How do you see the opportunity to create liquidity in those assets while they're still private? Do you think that the tokenization of those cap tables is going to help with secondary market liquidity? And then secondly, eventually some of those are going to want to go public. And so what does an on-chain IPO look like? You must have thought this through. What's that going to be like?
We'll need more minutes, I guess, if we want to chat about that. But basically, so on liquidity, I think one of the first use cases that we want to release is for employees and early investor, the opportunity to do equity link note directly from their portfolio. Like something where they will be able to get equity link notes, equity link financing. It's basically the opportunity to use your shares in a private company as some form of collateral to get some cash. And today it's extremely hard to do because it's expensive. It requires a lot to process. But the moment that you do that with DeFi Rail, it's obviously much easier. Down the road, of course, we see all the swapping, all the trading using DeFi, and we already have most of the smart contract where ultimately we try to blur the line between private and public markets, but without doing IPO, because a lot of companies don't want to IPO today. Just a fraction of them are ready to do that. And if you think of the example of Stripe, Gusto, those guys ended up spending a lot of time and effort raising capital, equity round, just to try to exit their own employees and bringing them some liquidity.
Yep.
So we need to come with a solution that is much more efficient for that. And I think DeFi is the right rail for that, but it comes with what I call regulated DeFi, in a sense that regulated agents are the ones that are needed to make it happen. And my vision for the next years is probably that we need to come with a very industry answer where we team up with all the startups, all the projects that are working today in this market, so that we can offer, like I would say, an arbitrage to what the incumbents are trying to push as an agenda today. And the only way to be successful on this is really like getting everyone together, having people like you that are running this digital assets, digital securities initiative, the Tokenized Asset Coalition with Johnny. I saw Johnny earlier. So all those teams are answers where we can team up and we can push an agenda and make sure that the regulator hears us and make the right arbitrage.
Yep, absolutely. Cheers to that. All right. Thank you, Joris.
Thank you.
And thank you, everyone, for joining us.